Okay, another week behind us, another week ahead of us. We're going to have a look at a lot of stuff this weekend. I guess the big question is everybody okay? Because that was quite the week with an ugly, ugly Friday. The only thing to smile about on Friday, I think, was the last 20 to 30 seconds with a lot of money rushing in, pushed the index up 20 points into the close, about 20 points into the close, because we were down about 160 points at one time. So that was about the only thing to smile about all day long, but I think we all walked into the weekend full of blood, because I saw red everywhere. I think green was, few and far between. So let me tell you what I'm going to do this week, just so that you have an idea of what's filling all of this time. I think you see the amount of time that I'm going to use. I don't even know what it is because I'm on my first screen. I just know in my trial runs I've gone through a lot of time. Every week I get some good questions under the videos in the comment section, and then I get questions that are signs of a weak mind. Things like you're biased, and that's the big comeback. That's why you disagree with me, because I'm biased. Let me tell you something about biased. Everybody is biased. I don't jump off of buildings. You know why? Because I'm biased by science. You know, that gravity thing? So I don't jump off buildings. I'm biased. So when I look at the facts and I come up with an opinion, yeah, I'm biased by the facts. Everybody's biased. So to say, oh, you're biased, you're only saying that because you're biased. Yeah, I am. And you are too, because I'm not saying stuff you already believe, which means to say that I'm biased means you're biased. And if that's the best you got, if your intellectual horsepower is redlining at the statement you're biased, you're probably not going to understand a lot of what I'm talking about. Maybe this is the wrong site for you. Other times, I get some really good questions. So some of the questions I had were why I'm using par rates. How am I interpreting the break-even rates? All good questions. I've talked about them in previous weekly updates, but we have a lot of new viewers over the last month, and I haven't really explained it more than just the first time. So I'll explain it again. I'll take some time on that. Then we're going to look at the economy, and we're going to look at earnings. The big thing last week, two big reports, GDP. We're going to break that down in terms of C, I, G, and X minus M, and see exactly what contributed to GDP and what took away. Then we'll look at PCE and the components of personal consumption expenditure and the price index, the PCE price index. We'll look at the employment cost index. And I'm going to point out a contradiction in the employment cost index from what people, when I say people, I particularly mean politicians and elected officials, what they say and what they truly believe based on how they react when they get what they want, or when they get what they claim they wanted, and how they react. And we'll see that I think politicians say things just to get votes, but they don't really mean it. They just say stuff to say stuff. We'll look at earnings. We'll look at some fundamental levels on the index. We'll look at skew on the index, because it's setting itself up nice for risk reversals. Whenever we have increased skew, risk reversals have a nice risk-reward payoff. We'll look at some apartment REITs. Mostly the Canadian apartment REITs are down around 20%, which I think is a nice buying opportunity. Especially ones with, options. Not a lot have options, and when they do, they're not that liquid, so you got to do the best you can. But one sort of sets itself up nice to triple the dividend just with the options. I'll show you how that's done. We'll look at the U.S. dollar, because that's potentially something is causing the U.S. dollar to strengthen, and it's a combination of a few things, with one big thing that could become a problem. And then we'll look at oil. There's a particular chart pattern on oil that is setting up for a summer breakout to the upside. And it can be, we can look at some fundamental data behind oil, primarily inventories, the current inventories against the 5-year average to, support that move. Lots to get through. Let's start with rates. You can get these at treasury.gov. and then just click on data, and you'll click on the first menu item and you'll get the Treasury par rates from the 1 month all the way to the 30-year. These are what are called constant maturity rates. So when we say the 10-year is at 2.89, what if there's no 10-year that day? To have a bond with exactly 10 years to maturity pretty much only happens on auction day when a new 10-year bond is issued in the market. Then it's a 10-year bond for 1 day only. The next day it's a 9-day and 364-day bond. So 10-year bonds that were issued 2 months ago are not 10-year bonds anymore. They're 9-year, 10-month bonds. So how we get the yield on a 10-year is you'll take a whole bunch of bonds that are in and around the 10-year, wherever they happen to be, and they'll have different yields to maturity. And then you will interpolate between all of those what a 10-year yield would be if a 10-year bond was issued that day. They're called par rates because if the bond is issued on a particular day on auction day, it's issued at par, and the yield at which it was bid at becomes its coupon. So if the coupon and the yield to maturity are identical, you have a par bond. That's why they're called par rates. Because you can't observe a 7-year bond every day and a 5-year bond every day and a 10-year, so they're interpolated. And every day they're reinterpolated. That's why they're called constant maturity yields. So every day we're quoted the 10-year, we know it would be what the 10-year would be if a 10-year was available that day, or at least as close to it as possible. And the bonds in and around the 10-year that we're using are the most on the run or the most recent bonds in which to interpolate for. So it's our best guess as to what the yield to maturity on any of these tenors would be that day if a new one with exactly that time to maturity were available. Well, have a look at what happened this week. Look at this, a bunch of nothings. You had huge volatility. Whenever you have a lot of volatility in rates, if something is up 4 basis points or down 2 basis points, it's basically unchanged. Look at slope, same thing. 1 or 2 basis points. I'm not prepared to read anything into that. So over the course of the week, rates did not change. Basically, I mean, these are too small to say that that's any kind of information in that. And I made this case last week. We have up 1 basis point. If the market was open for 5 more minutes, would it have been 0? Would it have been negative 0.01, right? So you can't really read anything into that. But overall, not changing, especially given that the market was as volatile as it was. And usually when you have sell-offs, money has to go somewhere. Money usually goes into safe places to hide, which tend to be more of the short part of the curve. We could see a lot, money went into the 1 month, but came out of the 2 month. For it not to change says something on its own that the market may be thinking that, maybe yields are fully pricing in the move of the Fed. So let's head down here first. I'm putting a weighting of 95% on a 50 basis point hike next Wednesday on May the 4th. I still got 5% on 25 because they're going to announce balance sheet runoff. And if we believe that they'll hit their targets, the 60 and the 20 for 80 billion a month, 60 on treasuries, 20 on MBS, that's 960 billion a year. That's being equated to an equivalence of a 25 basis point move, 0.25% of a 25 basis point move. So that's why I still leave some on the 5% because they may say let's move 50, but balance sheet runoff is 25, so let's move 25 to make the 50. If they move 50 basis points on the rate and do this, it's the equivalent of 75 basis points. But this isn't going to have the same psychological effect, nor is it going to have the same direct mechanism on markets. There's already so much liquidity that if you're taking $1 trillion, close to $1 trillion off the balance sheet, you still have a very liquid market in that respect. So, think of a pool and you're going to drain that pool 3 inches. Yeah, sure, you've drained some water out of the pool, but 3 inches is still a lot of good swimming there. So I don't think that this has as big an effect, and I think they want to make an effect I think 95% on the 50. And if you look at where rates were from the beginning of the year to where they are now, this is this bottom line telling you how much rates have moved over the year. We've already seen a 25 basis point lift. You add a 50, that's 75 basis points. You know, the market seems to have, it's already there. You could slide 75 in, and all you'd be doing is pushing up the 2-year by another 8 basis points. But the 3 years already made room for 75 basis points all the way down. Every maturity has made room for 75. We've got 25 of it already. You slide another 50 in there. Yeah, like I say, the market's already moved for it. So that's why I sort of think, well, I think they'll lean more towards that. When we look at PCE, and we've seen it with CPI, we have seen a moderation of inflation. Not enough yet, but it is going in the right direction. It's still increasing, but it's increasing at a slower and slower rate, meaning that, you know, all we have to do is get the increases to zero, and you have zero increase month over month. Prices don't actually have to retrace to where they were before. They just have to stop going up. Well, they are going up at a slower and slower rate. So as we stand right now, really, I don't have much commentary on the nominal rates themselves, because nothing much has changed, which in itself is a statement considering what happened in equity markets last week. So that, you know, as I said earlier, could be that the market is saying, look, I think we're fully priced in here. Plus, there was no Fed speak last week. They're in that quiet period, right? So they can't come out and scare everybody every couple hours. They were quiet last week. So maybe, you know, the open mouth operations is what was moving rates up. And without that, everyone's saying, well, we have no information now. I guess we'll wait till May 4th. That's a big day, May 4th. So I know all the caterers and all the bands are booked for Wednesday. If you're throwing your Fed party, it's probably too late. You're not going to get one of the good caterers. You're going to have like pizza delivered or something. So stock up, get ready. You know, your noisemakers, your party hats. You know, get those glasses that say, you know, 50 BPS. You know, that you look through. It says 50 basis points of credit. Get all the party favors and throw your party. But it's going to be a big day. With a lot of volatility. And then, of course, it's the press conference after where, you know, we get to hear what he has to say in terms of what we think will happen at the next meeting. But we are fully expecting this to be announced. It was already in the minutes. I am expecting that to be announced. I think they've well telegraphed 50. They've even started mentioning the 75, and you mention the 75 to make everyone get used to the 50. Because if everyone's thinking 50 to 25 and you get 50, it's a shock. But if you say, hey, it could be 75, and you get a 50, you think, whew, great. What I think will support the market is the Fed maybe signaling that we are seeing some improvement. If they say things like that, we're seeing some improvement in inflation. We are going to move measured, and, you know, without saying, you know, if he starts saying we need to accelerate this, we got to move fast, we're going to move quick, front end load a lot of this, yeah, it could get a little tight. Let's look at real rates and break evens. Bit more of a story over here. Our real yields have all moved up enough that you can say that there's some information here. It's not just 1 or 2 basis points, but they moved up, and the 10-year is now got its head above water. The 30-year up to 40 basis points on a real yield, 20-year at 27. How do we get these? We just look at the yield on tips. These are Treasury inflation-protected securities. And then for the break-even rates, if you go back to the last screen and you take the 5-year nominal rate and you subtract the 5-year real rate, you'll get the break-even rate. And this is saying, this is the rate at which consumers, or I shouldn't say consumers, investors are saying, I am indifferent. If inflation is actually at the beginning of the year, here we are here at the break-even rate, 3.3. If inflation is 3.3%, I would be indifferent between a nominal 5-year bond and a real 5-year bond, because the real rate is negative 0.38. The nominal rate is 2.92, so the break-even rate is 3.3. I'm indifferent. If I think inflation is going to be higher than 3.3% over that 5-year period on average, I will take a TIPS. If I think it's going to come in lower, I will take a nominal bond because the yield is overstated. So those are break-even rates. And the longer we go, the lower it should get, and it should approach 2% at the long end of the curve. That means if we see something like this around 2%, the 10, the 20, 30, we call inflation expectations well anchored at the 2% long-term inflation target, which the Fed has. For a while, they were increasing. The break-evens were increasing, which means inflation expectations were becoming unanchored. And when they become unanchored, you have to start talking really loudly to get investors to start thinking that, okay, you are really going to fix this problem. So a lot of what the Fed says is more about managing expectations for inflation than actually managing inflation, because you want to keep these rates well anchored at 2%. Well, doing its job, right? It's coming in. Real yield, nominal yields are flat. Real yields are increasing. So in the TIPS market, the investors in that market are saying, "Hey, you got to give me a higher yield. Got to give me a higher real yield to step in here," which is lowering inflation expectations. Those are your break-even rates. So that's how we interpret that. And as long as these are starting to head down, it's from the Fed's point of view, it's like, okay, they're heading in the right direction. Expectations are heading in the right direction. So the Fed has two jobs, right? When it comes to inflation, there is expectations and there is the actual real thing. Expectations you can manage just by talking. If you can talk, and then of course you have to act if things get out of control, or without acting, the market has to absolutely believe you're going to act. That is called credibility. And as long as a central bank has credibility, it can get away with a lot of talking, because it can make the market move for itself without actually having to do it itself. But if a central bank has no credibility, then these become unanchored and they continue to increase. Then there is nothing left but to actually do the work. That means you actually have to raise rates and raise rates and raise rates. This was the problem in the 70s. Going into the end of the Carter administration, is the central bank lacked credibility when it came to inflation. So inflation expectations were not well anchored and just kept increasing. And when you have the expectation of inflation increasing, it becomes a self-fulfilling prophecy, because if I expect it to be higher next year, I'm going to raise my prices in advance of that, thereby creating the very inflation I expected, which then reinforces that I was right to begin with and I should expect more. Volcker came in and said, well, we have no credibility, so we only have one choice, and that's to raise rates and to crush the soul of inflation. That's all we can do at this point in time. And to get the market believing that you're damn right we're credible, look what I'm doing. I don't think the central bank has that problem of credibility today. I don't think they do. I think if they go easy, I think if they went 25 basis points with very light balance sheet runoff, they would begin to lose that credibility. So I think they have to just do enough to keep that credibility, and that credibility will work on expectations, and the market will do a lot of the heavy lifting for the Fed and move rates to where they need to be without the Fed actually having to move them yet. So that's why, going back to the last screen, I sort of think 50 basis points is what the market is expecting. You have credibility. Don't risk losing it. The door's wide open for 50. Yields have already moved enough that you can slide 50 right in there without scratching the paint. So go ahead and do it. Look at mortgage rates, 30-year fixed, 5.41. I keep pointing this out, but you know what happens when interest rates increase? Adjustable rate mortgages become more popular. And right now, because the market is thinking, look, interest rates are going to increase for maybe a year, they're going to level off, and then they're going to decrease. So why would I lock in a fixed rate mortgage at this level right now? I'll go with a 5-year adjustable or a 1-year adjustable and see where we go. So whenever interest rates rise, the demand for adjustable rate mortgages also rises. So yeah, hard to take the 5.1 and say that that's the cost of buying a house now. I'd probably be looking more at the 4.38% as being the current cost, because they're rising. And even though they're rising, they really never make up more than about like low 20s in terms of percentage of all mortgages. They're not the bigger part of the market. The fixed rate happens to be, but you still have the 15 at 4.84. We're going to have a look at some rates and see if 5.41 is really something we should be that concerned about. Some troubling data. New home sales for March down 8.6% month over month, down 8.6%, which, we have low inventory levels, so that's kind of hard to pull apart. Are housing sales down because houses aren't being built in the right areas and you just don't have them for sale? So we do have inventory. There is a certain number of months of inventory, but we're at the low end of inventory levels. That does not mean that inventory is distributed uniformly throughout the country. There are some regions where, look, because of regulations in building houses and land use, it's a long lead time to be able to build homes. Maybe there just aren't any homes being built because with the shortage, they could be down purely because of supply. Either way, they're down 8.6% month over month. Mortgage applications ending the week of April 22nd, down 8.3%. The refi index is down 9%. The purchase index is down 7.6%. So again, that's not... now, mortgage, anybody buying a new or existing home would be getting a mortgage. So I think we have to say that there is some demand destruction going on because we're seeing the purchase index drop. This is the second week that the purchase index has dropped. The refi index, I'm not too concerned about that. It's quite normal. As rates go up, refinancings go down. That's a normal thing. But the purchase index, new home sales, yeah, that's leading to some demand destruction on that part. But, the other side of it is this. Inventories are still super low. So I don't know that that's going to hurt the home builders too much. Because inventory levels could be higher. Housing prices got overdone in a lot of markets by quite a bit. So, some leveling off and some pullback in the price probably wouldn't be a bad thing. It might be a healthy thing. But as far as economic data is concerned, I think we can say, yeah, there is some demand destruction going on in here. There's only so much we can blame supply for. At some point, you got to say, look, combine this with the price of a home, and yeah, is it surprising? So let's see if we can dig into that a little bit deeper. Okay, here's the actual release that came out Tuesday, April 26th at 10 a.m. It tells you who releases: U.S. Census Bureau and the U.S. Department of Housing and Urban Development. Link is in the description box below. And what do we have? New houses sold, 763,000. Notice that that is a seasonally adjusted annual rate. When you see SAAR, it's like a run rate. It's saying, well, if you sell one car a day, that means you're selling 7 cars a week. That's just a run rate. So they look at the number of houses sold during March and they say, well, let's control for any seasonal effects and then let's annualize that. So if we expect the conditions in March to last for the next 12 months, we expect 763,000 new homes to be sold. 407,000 new homes for sale across the country. Again, seasonally adjusted to adjust for any seasonal effects, because there are some seasons where the amount of homes for sale increases and then they decrease. Well, you can't just take a month where it really increases and say, look at all the inventory we have. You have to take it in perspective that that's a seasonal build, right? 407. So it doesn't take much math to figure out how many months of supply. What does 407 represent of 763 in terms of the months of supply? You get to 6.4 months of supply. And here we have I wouldn't call it a trend line, more like a sideways line for the last 5 years, 2017, 18, 19, 20, 21, and 22 month, year over year for the same month. So where we are here, 763, it's at the higher end of the range for the last 5 years. But down from where it was, post-pandemic. You had a lot more interest in let's get out of the city and let's get into the suburbs, which created a high demand for houses, and maybe we'll sink back to where the 5-year average would have been. Sales of new single-family houses in March were at a seasonally adjusted annual rate of 763K. According to estimates released jointly, this is 8.6% below the revised February rate of 835, and is 12.6% below the March 2021 estimate of 873. But that was elevated, so you had to take that with a grain of salt, that all of the spending trends that happened during the lockdown in 2020 and the aftermath in 2021 isn't representative, I think, of what's going forward. I think if you're looking for something representative, 2015 to 2019 period is probably more representative. For sale inventory and month supply, seasonally adjusted estimate of new homes for sale at the end of March was 407. This represents a supply of 6.4 months at the current sales rate. And if you want to dive deeper, it gives you more data in terms of where in the U.S., the Northeast, the Midwest, the South, and the West. And there's more tables where you can dive into a lot more. If you're into this kind of thing and you're into the home builders, and you know that home builders concentrate in certain areas and you want to see the effect in certain areas, this is certainly a fundamental report that you don't want to miss. Okay, another couple of charts on the housing market here. Here is the month supply of houses in the U.S. And as we've just seen on that last report from March, we have 6.4 months of supply. This is for new homes. Existing homes, I looked that up, 2 months of supply for existing homes. The bottom panel over here is the 30-year fixed rate mortgage average in the United States, average over the course of the month. So on the previous screen we saw the 30-year fixed at 5.41. That is as a certain date. This is 5.1. That is over the course of the month, the average over the course of the month. And a couple of interesting things to look at. These two were different time series, so I couldn't line them up exactly. So I tried to line them up as close I can in terms of when the recessions happened. So let's just look at a few things here. We have rising, I've pointed out where we have rising number of months of inventory available, and you get that by either sales dropping and the same amount of supply, a constant supply coming on over time, but sales dropping, the amount of months of inventory will build. Or you get too much supply coming onto the market, or a combination of the two. Sales are dropping while supply is still coming on the market. You will get an increase in the number of months of supply. When supply pulls back and says, well, okay, we've overbuilt, or now's not the time to list a home, supply pulls back and demand starts to improve. You get demand is improving and supply is cutting back. At the same time, you will get a drop in the number of homes available for sale. So 1, 2, or a combination of 1 or 2 will cause this. Same here, 1, 2, or a combination of 1 or 2 will cause this. So let's just have a look at the last 4 peaks that we have here. Going into, this is the 1975 recession, you see this big build in the number of months of supply. But you also see that rates were increasing at the same time. So when I see mortgage rates increasing, it raises the cost of ownership of a house. Maybe that cuts demand back, so demand tends to fall off. But new houses still come onto the market because if you look at a timeline, you get your building permits. Well, actually, you buy your land, you get all your approvals, you get your building permits, you do your housing starts, and then you have your completion. Well, if things go wrong over here, well, your financing is in place. You got to keep going. Your bank is not going to say, you know what, let's just put the loan aside for now. We'll come back to it in a year or two. No, you got to keep going. So even after the market turns against you, you got a lot of homes under construction that, well, they're going to keep hitting the market. So you have increasing supply. This looks like demand destruction. You're raising the cost of home ownership. Demand pulls back a little bit, but supply is going to keep hitting the market. You're going to have a run up in the number of days of inventory available. Look what happened over here. You had a big run up here. You had, if you look closer, you had rates going sideways for a bit. You had some stabilization. Then months of supply started increasing again. Look at where mortgage rates went to. There is classic demand destruction right there. Over here, this is where it starts to get interesting. The last two peaks are rather interesting, and they have an after effect. So we can sort of think about what the after effect might be to what's going on now. You see the number of months of supply slowly building into this particular recession, 1990. As we know through history, that was a period of overbuilding. So you had oversupply. There was a significant housing correction in the 90s, overbuilding. Why do I say that? Well, look at what was going on with rates during that period of time. They weren't increasing. In fact, over time, they were decreasing into that recession. Lower rates make housing more affordable. And you still had climbing inventories because you had massive overbuilding, overinvestment in that sector. Whenever you get overinvestment in a particular sector and then a bust, you get underinvestment in that sector for a number of years after, so you end up with chronic shortages. That is what's going on in the oil market. When we look at where inventories are, we'll look at where CapEx is and where the price is, and we'll see that we still have massive underinvestment going on, but you end up with chronic shortages. And if chronic shortages persist for a while, more and more people come into the sector, and of course you start to get overbuilding again. And here's what we have: overbuilding. We know 2006, 2007, 2008 was massive overbuilding. The number of months of inventory, from way back here, 2006 started climbing every month. No alarm bells were raised, kept climbing and climbing. We're in a recession. Why did it keep climbing? Because all those homes under construction aren't going to turn around. They're not just going to stop. They're going to keep going. You got to get them done because you have bank financing on all that stuff. The builders got to meet that. So that's what they're going to do. Rates were going sideways. Rates were going sideways. It wasn't like rates were going up. If rates were going up and this was happening, that's a classic sign of demand destruction. You're raising the cost of ownership. We would expect to see inventories build, but this was overbuilding. What happens when you get overbuilding, too much investment in the sector, and then for years after you get way too little investment in the sector, and you end up with chronic shortages. And that is where we are right now with chronic shortages. I don't see any of this stuff going on in housing right now. I don't see any of that happening at this point in time. Even though at this far end of the curve, mortgage rates have gone up, I'm not seeing these big run-ups in the amount of inventory that we have available. So am I going to read a lot into existing home sales being down month over month? Am I going to read a lot into the sales index for the mortgage applications being down for 2 weeks in a row? Not a lot. I'm going to say, yeah, okay, it probably pulled some people out of the market. Maybe it made some people nervous and they said, why don't we just wait and see what happens? Let's just wait a couple more months, because I'll tell you, I know 2 people who are saying, I'm in the housing market, but we are now waiting till the fall. They're just not going to buy right now. They're going to wait till the fall. It's not demand destruction, it's demand delayment. They're just going to wait till the fall because rates are going up. They think it's going to push housing prices down a little bit more. Why not wait till the fall? So it could be that, you have these drops that could signal that it's not that demand has gone away, but demand has just moved to the sidelines and said, we're going to wait over here for a while. But inventory doesn't seem to be wanting to go along with them. When we think interest rates or mortgage rates are high, here's where we are. Draw a line. Over here, this is a 50-year time series. Look at that. It wasn't until 2011 that you actually got below 5%. They've historically always been over 5%. Historically always been over 5%, and there's always been a housing market. So, I look at the mortgage rates now. You look at the level of inventories, they're low. You look at the amount of housing available, and even especially in Canada, I wouldn't say even, but especially in Canada, there's a chronic shortage of housing. I don't know so much that rising interest rates really are going to cause too much of a dislocation in the housing market, only because your months of supply are way down here. And to destroy demand at these levels of inventory, you'd have to get mortgage rates back up to these sort of historical levels, 9%, 10%. All right, let's look at the GDP report that came out last week, and we're going to look at it in terms of its components. Any level 1 CFA candidate recognizes this equation. Any business undergrad took macro in their first year or second year. It's a required course at pretty much every business school, a micro and a macro. You recognize this. GDP, commonly called Y, which is output, is made up of 4 broad components: the consumer, investment, government spending, and the trade balance. One thing I'm going to stress here is GDP is a measure of output, not demand, a measure of output. So let's, just to put that in perspective, let's say that in a quarter, the economy produced a whole bunch of stuff, but nobody bought it. They just produced a bunch of stuff and inventories went way, way up. You'd still have positive GDP. You'd still have GDP growth if you produced more in that quarter than you did the last quarter. Even if nobody bought it, you would still have great GDP. In the next quarter, let's assume you produced nothing, but you sold everything from inventory. You would produce nothing. You would have a 100% drop in real GDP. So, GDP is not a measure of demand. It is a measure of output, how much is produced. If we're working down inventories, that's a negative for real GDP in the quarter because we're not producing anything in that particular quarter. Let's see how we get to negative 1.4, and I've added the terms here. Here's C, there's I, there's G, there's X minus M, and we get to negative 1.42. So the numbers I have here are their contribution to this negative 1.4. The consumer, 1.83%. So if we just said, well, never mind all these other terms, what was real GDP if we just count the consumer? 1.83%. Positive 1.83%. Goods down 0.03, services up 1.86. Well, this just is, I think, positive in terms of the trend towards inflation, because when the pandemic hit, well, you couldn't buy services, so everyone was getting free money. Well, I shouldn't say everyone. A lot of people were getting free money. Money doesn't stay in people's pockets in the U.S. They got to spend. Got to buy stuff. So, of course, they bought stuff. But since you can't buy services, all that money got channeled into goods, which, drained inventories around the world, empty shelves. Well, you got to reorder all that stuff. And some businesses, I think, Amazon, we saw this week, made the mistake of projecting that demand for goods was going to continue going forward. And even in their call, they said they think they overbuilt on warehouses. Because the demand for goods was bolstered by the fact that there was no demand for services. Well, now it's coming back with a vengeance. So this is actually good when we think about the effect on inflation. It will take price pressure away from stuff that actually has to be made. You need physical stuff to actually make that, and you got to ship that stuff. Services are local. So that was good. Let's move over to I 0.43. So if it was just C and I and we ignored the government and the trade balance, GDP came in at a 2.26% growth rate. Fixed investment 1.27, that's not bad. Non-residential 1.17, residential 0.1. This, we still are supply constrained here. It's a tight labor market. There's housing construction going on around here, and I know a guy who's building, he builds houses. That's what he does, and he's building 2 on a lot that he bought. And it's taken him a lot longer than he thought. He said, you know, I should have been done at the end of last summer. He says, you can't get stuff. You can't get this guy, you can't get that contractor, you can't get these. You spend a lot of time waiting. You can't get stuff. So that's not surprising. This, I think, has a lot to do with supply. Non-residential, 1.17. Private inventories pulled away, brought it down. Otherwise, this would have been higher. Private inventories, negative 0.84. But again, that's inventories going down. Well, inventories going down means they're sold. That means there was demand for inventories to be worked down. That's not what GDP measures. GDP measures output. So you look at that, you say, well, that means there was more demand. That means there was demand for inventories to drop. Okay, well, but that's the way we measure GDP. Good enough. Negative 0.84. Well, inventories, if inventories go down, at some point inventories got to go up. It could be that late in the quarter, that's when we got into March, that businesses started thinking, you know what, we'll work down the amount of inventories we have because we can see that demand is going to drop with rising interest rates, or it still could be a supply chain issue. And the auto companies have all reported, and they've all said the same thing. Look, supply is tight. It's tight. And they've all pretty much said the same thing. We basically sell almost every single car we make. And the days of inventory on hand have never been lower. That if they shut down for a period of a week completely, they'd be out of inventory altogether. So it could be that private inventories are decreasing only because you can't get stuff in and you have to pretty much work to the bare bones of what you have. This could be supply related as well, but either way, it still was a negative for GDP. Government, negative 0.48. Typically, I would say, what's not to like about that? I'd rather see them spend less and less and less and less. But in economics, we have simple little relationships. If the government spends more, that means the consumer has less to spend because the government is taking more. If the government spends less, that means the consumer has more because the government's taking less. But that's not how this works. Governments tend to spend on a level that is unhinged from the revenue they earn. They don't seem to pay attention to the revenue side. They just spend whatever they want to spend. And when they spend less than they had planned to spend, they still take the same amount from the consumer. So unfortunately, this just ends up being a negative. Federal, negative 0.39, state and local, negative 0.08. If you add the two together, I know that comes to 0.47, but this is 0.3946, so it's rounded down to 39. This might be 0.0849, which then gets rounded down to 48. So if you add the two up, you can get your extra basis point in there. For federal defense, down 0.33, non-defense down 0.06. Well, that's not surprising. In the first part of the year, you pretty much backed out of your overseas operations, so that's not surprising at all. This is a big one, eh? Look at this. That's the trade balance. If you get rid of the trade balance, you would have been plus 1.8%. Even with the pullback in government spending, 1.8%. You got to point to the strong dollar here. You got a big, strong dollar. Your exports are going to be more expensive globally. You should expect to see a hit to exports. Negative 0.68. Quarter over quarter, that's a drop of 5.9% in exports quarter over quarter. So first quarter of 2022. Exports dropped almost 6% versus fourth quarter of 2022. Imports, with a strong dollar, every other country's products are super cheap. So you'd expect to see that there. Well, negative 2.53. You may think, aha, that's a drop. Imports reduce GDP. GDP is gross domestic product. So everything you bring into the country reduces domestic product. So that is actually a reduction. It reduced GDP, that just imports on their own, by 2.53% because imports increased 17.7% quarter over quarter. Exports down 6%, imports up almost 18%. Strong US dollar. You show me a country which has a currency that's really strong, and I would probably predict that it has a trade deficit, that it probably imports more than it exports because its exports just got suddenly a lot more expensive on a currency conversion basis, but imports just got super cheap on a currency conversion basis. This is the problem here because you got something going on with the dollar. This is not that big of a problem. I think we'd rather see governments spend less money if they can, and spending less on defense. Whenever they spend less on defense, we always say there should be a peace dividend. But being that governments are so deep in the hole right now that any cutback they make isn't going to help anybody out because they're still spending way more than they take in. They are just completely unhinged from revenue. And that never used to be the case, but in the last, I think, 15 years or so, governments seem to just spend without ever paying attention to revenue. If you're wondering where to get this, it's the Bureau of Economic Analysis, the U.S. Department of Commerce, BEA.gov. Let's take a look at the report itself because the tables are rather interesting. Okay, this is the release. If you've ever wondered why, the moment it's released, see, notice it's embargoed until release at 8:30 a.m. Why on the release do you suddenly have news outlets that pretty much have all the detail of the GDP report? They know numbers from the tables, they can tell you this, that, you have press releases, everything going on. Why is that? Is because they get it early. It is embargoed until release at 8:30, meaning we're going to let you see it early so that you can do your news stories, but you cannot release anything until 8:30 a.m. And if you mess up, that's it. You're out of the loop. You'll never see this again. You will always be at a news disadvantage. So nobody messes with that stuff. Anyways, here is real GDP. Here is the dislocation from COVID and the big bounce back, and off we go. And whenever you have this kind of thing going on, you're always going to have some volatility in GDP. You're going to have some amplitude for a while until it finds its level again. Let's have a look at the appendix of tables, because it's the tables where the interesting stuff are. We're going to look at table 2, contributions to percent change in real gross domestic product, which is what I showed you on the previous screen, but we'll look into a little bit more detail there. Then we'll go into the appendix, table 8, real gross domestic product and related aggregates, to look at a few more categories. So let's find table 2, and here is table 2. And this is where I pulled the numbers from. We can see right here, personal consumption expenditures. If you read across, there's the 1.83 that we noted. I know the printing is small, but there's not much I can do about that. You can always just get the report and just find the numbers on the report yourself. You go to line 3 under the last column, 2022 Q1. There's the negative 0.3 from services, and if we come down here to line 14, there's the 1.68. 1.68 from services, negative 0.03 from goods, and it'll tell you, it breaks it down. Durable goods actually was a positive 0.35. Actually added 0.35 to real GDP. It wasn't until you get to non-durable goods you get negative 0.38. But durable goods and motor vehicles and parts, 0.29. Motor vehicles and parts added 0.29 to GDP. Well, that's good. And you can read all of the line items of where things are, and if you're interested in certain broad categories: transportation services, healthcare, housing and utilities, food services, accommodations. These are big broad sectors. I shouldn't say big broad sectors. They are subsectors of the big broad sectors in the economy, so you can see whether or not your sector was well represented. And gross private domestic investment, there's the 0.43. We can see fixed investment 1.27. And if we're looking for changes in inventory, it's down here, line 40, negative 0.84. And it breaks it down between farm inventory and non-farm inventory. For fixed investment, you have non-residential and residential. We can see residential added 0.1. Non-residential is up here, is 1.17. Now, earlier I said there is some supply bottlenecks in housing, so housing is being held back more by availability of supply. Then what's going on with non-residential? How come there isn't a labor shortage or supply shortage there? Because it's not structures, or not all structures. You do have structures. Notice structures were negative 0.02, but equipment 0.79, and intellectual property products 0.4. So a lot more investment going on there. And when we say intellectual property products, this is investment in big things like autonomous driving or software, anything like that. Then you have the government consumption, negative 0.48, breaks it down from federal and state and local in terms of what they're spending on. And then finally you have your where are we? There it is. Sorry, I ran right over it. Net exports of goods and services. That's the big one, negative 3.2. And I think King Dollar there is doing a lot to affect that. And when you have a central bank that is saying we're going to be aggressive in raising rates, and you have the Bank of Japan saying we're not, and you have the ECB saying, well, yeah, later though, but not right now. Well, what's going to happen to King Dollar? It's going to become more King Dollar, which means that this is going to be hard to overcome because the U.S. exports are going to just relatively be more and more expensive, and other imports are going to be cheaper and cheaper. So that's your issue. That's a big one, negative 3.2. Get rid of that. Again, get rid of that. Real GDP was 1.8%. 1.8. Let's go down to Appendix 8, or Appendix A. I think it's on page 15. Here it is. So this is real gross domestic product and related aggregates. You have percentage change from preceding period and contributions to percentage change. So this is the percentage change from the preceding period, and this is the contribution to percentage change in real GDP. So we know it was negative 1.4%. There it is right there. This, you can add up this final column to get to 1.4, but it gives you an idea of where it actually came from. And again, this is output based, right? This is the one I'm interested in, number 5. Look at this, negative 6.6% on percentage change over the previous period, over Q4 of 2021, negative 6%. That's output, right? Fewer vehicles being produced. And if we look at the contribution to GDP from motor vehicle output, we could see that took away 0.19% or contributed 0.19 to that negative 1.4. We've had the car companies report, and all of them are talking about, as I said earlier, constrained supply. They simply just can't get the stuff they need to increase the amount of output. They don't have a demand problem. None of them have a demand problem. Tesla has no demand problem. Ford, GM, no demand problem. It's all a supply problem. They all agree on the same thing. It's a supply problem. So that supply problem is constraining growth in real GDP. So if supply constraints improve, because they don't have a demand problem, if you improve the supply, you would naturally just improve real GDP. Interest rates aren't going to solve that. Higher interest rates are not going to fix that, and you can still have higher interest rates while supply continues to improve to meet demand, which is already higher than supply anyways. You would have to destroy demand a lot to get rid of that. And for cash buyers, they're unaffected by any change in interest rates. Okay, there is GDP. Let's look at PCE. All right, here is Table 8 from the report, Personal Income and its Disposition. The link to the full report, again, is in the description box. A lot of stuff going on in this table, but it's fairly straightforward to read. Again, if you revisit Level 1 macroeconomics, the first reading in macro really covers the calculation of personal disposable income, which is what we have at line 15. So we start at personal income, we make a bunch of adjustments, we get to disposable personal income, and then we deduct what we spend and we get our savings, and from that we can calculate a savings rate. Let's see what we have. Personal income, what is that anyways? It is national income less corporate profits plus any inventory adjustments plus any CCA adjustments. So add up these three components, take it off of national income, and that is personal income. Here is Q1 2022, 21.2 trillion, because this is in billions of dollars. That is not for the first quarter. These again are still seasonally adjusted annual rates, so they're run rates. So it's like, well, this is what they made in the fourth quarter. Let's seasonally adjust the first quarter. Let's annualize this. This is our best guess as to what annual personal income will be based on the information that we have now, $21.2 trillion. And it breaks it down in terms of the compensation of employees, and breaks that out into two groups, wages and salaries, and supplements to wages and salaries. And from this, we get the employment cost index. And the employment cost index, as we will see shortly, is broken out into wages and benefits. And we're seeing that benefits increased a lot, and wages were up quite significantly. It was the ECI, by the way, that created a bunch of fear on Friday, and that's why the market sold off. And I didn't read it that way. When I saw that, I said, that is fantastic. That is good news. That is the lake being restocked. There's going to be great fishing this summer. Right? I've said many times the most efficient form of wealth transfer is higher wages. Whether it be in wages or benefits, higher wages is the most efficient form of wealth transfer and income transfer. You have politicians that for a long time want to point out that people aren't being paid enough. We need to raise the minimum wage. You have greedy corporations that don't want to pay their employees. And just when corporations start paying their employees, you have people coming out saying inflation is running away. We got to do something. Got to raise rates. This is just not a good thing. It's a sign of an overheated labor market. These wage hikes can't keep going on, and they want to slow it all down. It's like, well, wait a minute here. Didn't you just say last year that we were all greedy sons of bitches for not paying the employees? And when we start paying employees, now you're accusing us of destroying the economy with wage inflation? Which is it? Which thing am I guilty of here? This is why I think politicians say things just to say things, but I don't think they actually believe what they say. If you want a true core measure of inflation, it's wage inflation. That's a true core measure, because that is how much they can spend. That we should be happy with, saying, listen, there are certain costs that have increased dramatically. Housing, healthcare, tuition. And either they have to correct downwards or wages have to correct upwards. Wages are correcting upwards right now, and everybody wants it to stop. So when I saw the employment cost index, I thought, this is good. Anything that disintermediates the government. Why should the government be responsible from taking money from people and pretending to give it to other people to try to fix income inequality and wealth inequality? Let the market do it. The market is doing it. Get out of the way. It's like a lake that you fish in being restocked. Yeah, you got to restock the lake every now and then, but talk about the fishing we'll have going forward. Remember, these people spend pretty much every penny they make. You give them more money, they'll spend more. Anyways, breaks it down to wages and salaries and the supplement to wages and salaries. We'll look at the employment cost index shortly. Proprietors' income with inventory valuation, capital consumption adjustments. This is sole proprietors. This is not corporations now. It's sole proprietors, because the income of a sole proprietor is the same as personal income. If you have a sole proprietorship, it's the same as personal income. And that breaks it down into farm and non-farm. Rental income, personal income, receipts on assets. So there's interest and dividend income, because the population does hold bonds and it does hold stocks. It gets income in terms of interest on coupon payments and dividend income. Current transfer receipts. This is the government paying people. Less contributions for government social insurance. So they pay you and then they take it away. Saying, here's some money for you guys. Oh, you guys over there, you got to give us this money over here. This is government intermediation, stepping into the market saying, we're going to take some money from you people and we're going to give it to you people. But it all still counts as national income. And there's current taxes. And there's your disposable income over here. Less personal outlays, we get a savings rate. This is 1.2 trillion. Again, seasonally adjusted annual rate that Americans save $1.2 trillion a year based on what we've seen so far. This is in line with the 20-year average, but it is below the 10-year average. So there is some pointing to the low savings rate, 6.6%, saying that for most households to meet their budget with increased inflation, they have to sacrifice saving for retirement. They're saving less for retirement now. But that 6.6 is in line with the 20-year average. Just it's below the 10-year average. So there we are at 6.6. These are the interesting lines here, line 19 and line 20. Let's make sure we know what we're reading when we're looking at it. This is personal income excluding current transfer receipts. In other words, never mind what the government gives people. Let's just look at what people earn on their own. Never mind what the government gives them, and let's adjust it for inflation. And when it says billions of chained dollars, that's the PCE. Because the PCE is a cost of living index. So when we say chained dollars, we're looking at the cost of living. So this is adjusted for the cost of living index. And we're going to look at two numbers. I got them labeled here, 1 and 2. So number 1 is Q1 2022 over Q1 2021. Both of these are seasonally adjusted annual rates, annual run rates. Number 1, plus 2.4% year over year for Q1 in terms of personal incomes, not counting what the government gives you, just what everybody earns on their own. Up 2.4% year over year for Q1. What's the second measure here? This is 2021. This is what we've observed or what we know for the full year. Since this is an annual rate, we could just compare this annual rate with this number here. It's up 0.9% over 2021, over the full year of 2021. Now, let's give everybody money from the government. And that's what this is. This is disposable personal income. Again, billions of chained dollars, so it's controlled by the same PCE price index as 19 is. So I say here, adjusted by the pre-PCE. It's called a price deflator as opposed to an inflation index. It's called a price deflator. We're going to do the same calculation. Let's do Q1 of 2022 over Q1 of 2021. And we are down 4.17% year over year for Q1. Without counting any transfer payments from the government, up 2.4%. Once you add transfer payments from the government, it is down over last year 4.17%. What was going on in Q1 of 2021 that was not going on in Q1 of 2022 as far as payments from the government to people? They were lower. Some unemployment has run out, and some pandemic relief, well, almost all of it has run out. So payments from the government to individuals all sort of ran off, and that was it. You just weren't getting money from the government. So those who were out there earning their own, not counting any receipts from the government at all, it was up. I shouldn't say those that were out there earning. I didn't mean it that way. I meant that for what they're earning on their own, it's up. But what was given to them on top of all of that brings it down. So negative 4.17 year over year. If we look at the Q1 number versus, which is an annual run rate over all of 2021, it's down 10.93%, almost 11% over 2021. This got some attention. This sort of got ignored. But at some point you have to say, look, at some point the government's got to stop giving money away. And is it fair to look at incomes this year versus last year when the government was just handing money out? Is it fair to do that? Probably not, because you can't keep that up forever. So if we're saying, oh, that's a bad thing, and oh, that's a bad thing, what we're implicitly saying is the government should still be handing out money left, right, and center, and deficit spending and deficit spending and deficit spending. That has to end. So I think the comparison was just, something that was a little too extraordinary to compare against. Even 2020. Even going back to 2020, a lot of money was handed out in 2020. We're at 15,339 versus 15,672. It's still lower over 2020. But if you go back to 2019, 14,755 versus 15,339, right? And again, go back to 2019. You got 13.9 trillion. Here you got 14.4 trillion. You do have growth. If in the line 20 here, if you control for the fact that let's pick a year in which the government wasn't making everyday Christmas, and we're fine. So these numbers here, I think, are you have to take them in context. I'd be more apt to pay attention to row 19, and I'm more than happy when we see the ECI. I'm more than happy with these numbers. Let's look at those. All right. Table A, major series of the Employment Cost Index. And then we'll just scroll up here. This is from Bureau of Labor Statistics. This is the Employment Cost Index summary. And right now we'll just pay attention to the 3-month seasonally adjusted columns, one for March 2022 and December 21, just quarter over quarter. This first category is for everybody. Then it breaks it down into those in private industry and those in state and local government. We'll just look up here. Compensation 1.4% quarter over quarter. Wages and salaries make up 1.2 and the benefits make up 1.4. Well, I look at this and I think, good. This is what I want to see. I want to see wage increases. I definitely want to see that because you have inflation. So let's get some wage increases in here. Listen, for the last 10 years or so, it's been a sort of a political win card to keep talking about how low the minimum wage is. It's not a livable wage. We got to get it up. $15 minimum wage. Is that too much to ask for? Now I'm hearing, 20 should be a national minimum wage. Well, this is what's happening. Wages are going up. Why, I don't understand why we're so concerned about wages going up. Yes, it's going to cost companies more. But wages are not 100% of the variable cost. Wages are a proportion of the variable cost. So if wages go up 5%, it's not as if all prices have to go up 5%, because there is value added. There are other components that make that up as well. And if you pay people more, they spend more. So you can margin out on a few products, or you can accept a lower margin and get quantity in exchange. You're just paying everybody more. And being that they spend, most of them, 70 to 80% of people spend every penny they make, pay them more means they spend more. They spend more, that's more stuff. There's volume. You can make it up on volume. So I'm not too sure why we're upset about the lake being restocked. And you can think about it that way, is that if we are investors, we need consumers to make money on. And the healthier you make the consumer, the better our future happens to be. Margins might take a small hit, but margins have never been better. 12% as a percentage, corporate profits as a percentage of GDP, 12%. The long-term mean reverting level used to be 6%. It's double that amount. Not only that, if you have increases in your wage expense on your income statement, there are so many ways to get productivity gains now that you didn't have 20 or 30 years ago. There are significantly more ways to get productivity gains. So I'm not seeing this as a problem, but apparently the ECI spooked the market. It was oh, we're going to have a wage price spiral at this point in time. Look, as I've said, so many things have increased in price to the point that they're ridiculous. They either had to correct or wages had to correct. I would rather see wages correct. Good enough. This is what I find interesting. This is the 12-month, not seasonally adjusted. This is current dollar. This is in nominal dollars. You can see March 4.5, 4.7, 4.1. And this is not seasonally adjusted either in constant dollars. In other words, in real terms, it's negative. Have a look at this. This is interesting, right? Private industry, compensation, negative 3.5. But if you're relying on state and local government, they're down 4.9. Uh-oh. All the virtue signaling, let's raise wages, it's not keeping up, let's pay a livable wage, seem to be trailing the private sector. The wages and salaries, negative 5.1 versus 3.3. And benefits, negative 4.7 versus negative 4. I don't know. I think some finger wagging has to be done in the mirror for these politicians, right? Okay, PCE and our price indexes are down here. So we'll look at them in a second. What do we have at the top here? Personal income in current dollars. Disposable personal income in current and in chained dollars. So in current dollars, that's not controlling for any inflation. 0.5%, up 89.7 billion over the previous month. This is the DPI, disposable personal income. When we say chained, that means we are using the PCE price index to control for inflation, not CPI, because it's the cost of living we're looking at, right? Negative 0.4. So that's not such a great thing, right? Neither of these numbers here, these numbers aren't that great. Overall, negative 0.4. Personal consumption expenditures in current dollars, up 1.1%, $185 billion higher than the previous month. Once you control for the price index on this one, 0.2%. Goods down 0.5, services up 0.6. And again, these are rounded off, so maybe goods was 0.46 and maybe services were 0.64. If you do it that way, you can get to the 0.2. Let's look at our price indexes. And we'll look at headline and core. This is a percentage change from percentage change from month 1 year ago. This is for the year. This is for the month. So let's see what we have. 0.9 in March. And if you look 0.6, 0.5, 0.5, 0.5, 0.9. That was scary right away. And if we look at year over year, 5.6, 5.8, 6, 6.3, 6.6. Not going in the right direction. But that is headline. If you exclude food and energy, because as I say up here, higher rates will not fix food or energy inflation. Raise rates all you want. You're not going to fix food or energy inflation. They have their own dynamics. You have to grow food and deliver food. It's not a question of higher interest rates will get you to stop eating. It's just not going to happen. So if you control for that, you had 0.5, 0.5, 0.5. We saw this last time, dropped to 0.3, still held at 0.3 on core. And you look at the year over year, 4.7, 4.9, 5.2, 5.3, back down to 5.2. That is on core. So the core for the last 2 months is constructive. it's going in the right direction. Would like that to get to 0.00 for a few months. Then you'd have a significant drop in inflation if you can get that to 0.00. Even if you can get it negative, don't know that that we'll see a negative, but negative may really start to work on the average inflation over a period of time. But this is what also spooked the market that day is these big numbers, these headline numbers, because in the end, people got to buy food, they got to buy energy, you got to pay attention to that. However, the central bank is very well aware that no policy is going to affect food inflation or energy inflation. Only higher prices for energy will affect energy inflation, because it gets to the point where the price at the pumps are high enough where you say, that's it, you know what, I'm not going to go for that casual drive that I wanted to do. I'm not going to drive to the store for one item, I'll wait. Or you may start with public transportation or carpooling, or, like many people are doing, heading to the dealer lot to say, give me one of those electric vehicles. And depending on where you live, that electric vehicle may be coal-powered, right? Because you got to plug it in, and if all your electricity comes from coal plants, you don't have an electric vehicle, you got a coal-powered vehicle, or a natural gas-powered vehicle, or an oil-powered vehicle. You're just getting it from a different source. But yeah, this is what we have to fix. Now, if this starts coming down, if the base effects start removing these big numbers, as we would expect, but unfortunately I think we got to get into like June or July before we really start seeing the base effects take hold, then these numbers could be very supportive of a strong equity market into the end of the year. But our next read, if it's 6.6 or 6.7 or 6.8, and this is not improving, and this is not improving, then yeah, 50 basis points would be on the table for the next Fed meeting as well. All right, let's have a look at earnings. We had 158, 160, 170. I forget how many companies reported earnings last week, so we have some updated information. First bullet point, 22 Q1 year-over-year earnings expected to be 10.1%. Last week, that number was 7.3%. Excluding the energy sector, the year-over-year earnings estimate is 4.4%. Last week, that was 1.6%. So that's going in the right direction. 275 companies that have reported. 80.4 have reported earnings above analyst estimates. The year-over-year revenue is expected to be 12.5%. 72.7% of companies have reported revenue above analyst expectations. Let's look at the earnings outlook. Last week we just had this dot. Look at where we are now. Look at where this was the beginning of the year, and we are above that, heading to 450 for the earnings outlook. That's pretty impressive. If we continue down here, the surprise factor, 6.6%, earnings scorecard. The earnings versus expectations, how many have reported above and in what sector they're in, how many matched and how many were below. And the surprise factor, so 59.3% in consumer discretionary were above estimates, 40.7% were below, but it ends up working out that if you add up all the expectations for consumer discretionary, the actuals came in at 7% stronger. All the way down, look at financials, 10.3% stronger. Materials, 10% stronger. Where is energy here? Only 1.9%. You would say, why is it only 1.9%? Expectations were raised dramatically for the energy sector. So, with the raised expectations, it still has managed a small beat on top of that. 6.6% higher than expectations. When I do, on the next screen, I'm going to do some forward multiples, and I'm going to take the number and I'm going to adjust the number upwards by the 6.6%, because energy estimates were already increased. So if we're beating the estimates by 6.6%, well, let's take the estimate for the year and say, okay, well, let's say that we beat it by 6.6%. What would that be? What would the PE be, assuming the 6.6% beat? and then we'll look at some fundamental levels on the market. And you've been through this before. As we scroll down, we will get to here, which is our multiples. So we have, they use the Friday opening price because they don't wait till Friday after the market to release it. So we just have to adjust this price to reflect the closing price of 41.31. We have the EPS numbers here, and then we can calculate what the PE ratios are, which is what I've done. I've calculated that for you. And we have a lot of companies reporting next week. So how many are reporting next week? Reported is 275. And we have 160 that are going to be reporting over the course of next week. Next week's a big week. 160 companies reporting earnings, a Fed meeting on Wednesday, a jobs report on Friday. At the end, we'll look at the week ahead to see what we have. Here's May 2nd, the companies that are reporting May 2nd and May 3rd. Again, this link is in the description box, so you can search for any of the companies that you think might be interesting to you. Maybe they're not on your watch list, but you might think, oh, I want to pay attention to those particular earnings. Or you might see a company where you say, well, that could be market moving depending on what they report. Let's go look at some levels. All right, 2-year chart of SPY up, the ETF that tracks the S&P 500 index. Just divide the index by 10 and you'll get the price of SPY. The price here is 413.39. This says 413.19 if you're dividing by 10. We're close enough. So here are some levels on the index, and I've mapped it onto the SPY. Next 12 months earnings, 235.91. So I'm going to give an unadjusted and an adjusted. And I'm going to exclude energy altogether. So I'm going to take, if you go back to that table, take energy out altogether and just look at the other sectors and how much they're beating by. I'm going to say, okay, well, if they're beating by that much, if they're beating expectations by that much, and these are expectations, let's raise expectations by how much they think that we're going to beat by. And the blue multiple will be the predicted EPS, including the beats, and not just the predicted EPS without the beats. So one is unadjusted, one is adjusted. We had a closing, the cash market close on the SPX was 41.31.93. So at our current levels, we're trading at 17.5 times forward earnings, or on an adjusted basis, 16.42. If you're forecasting this as the EPS, and you're also forecasting a beat on the EPS, the best forecast is the number we saw, adjusted for energy, which is a little bit lower. You get the 16.42. Different levels based on just unadjusted, just the next 12 months. 16 times, the level is 33.75. At 17, it's 40.10. 18 is 42.46, and 19 is 44.82. So this gives you an idea of, if you were thinking about in terms of fundamental levels, where could the index trade as a multiple of forward earnings? Well, it could trade down to 16, you think. Well, then that is 37.75. You think 17 would be good support. That's 40.10. On the adjusted basis, 33.75 is 15 times forward earnings, including expected beats. 17 times is 15.95, 18 goes to 16.9, and 19 goes to 17.8. So if we think that companies can continue to beat at the same rate, and we think these are the next 12 months of earnings, we are currently trading at less than 16 and a half times forward earnings. If we think we can trade up to 17 or 18 times, that's 42.46 to 44.82. Without seeing what earnings are going to happen over the course of the week coming up, we may have further upgrades to that 6.6. Let's look at implied volatility percentile, IVP. I don't like the rank, I like percentile. 52-week, 26-week, and 13-week IVP, 99, 98, 95%. What does it mean? Here is implied volatility here. That means that this is higher than 99% of all the other days in the last year, in the last 52 weeks. Higher than 98% of all the observations in the last 26 weeks, and higher than 95% of all the observations in the last 13 weeks. Translation: we have elevated implied volatility on the market, on the SPY. So we had a pretty rough day on a closing, but we did not get, and it's hard to see, but right there is the intraday low set near the end of February. We did not get below that intraday low, but on a closing basis, we are closing lower than we have all year. On a closing basis, we've set a new closing low, which I didn't see happening. I didn't think that we would print new 52-week lows, but I didn't think we'd print new 52-week highs. I thought we'd be in a trending pattern for a while, but here we are. What I noticed last week is companies that had good earnings and good guidance were really not rewarded that much. Companies that missed even a little were punished to no end. And especially the high multiple companies were punished significantly to no end. So those are healthy corrections when you have these high multiple stocks. And every market has this. When you get to a point where you have selling like you had last week, or sentiment like you had last week, high multiple stocks do get punished. And they then, after this period, after periods like this, they then begin to trade at what is felt to be a more long-term fundamental growth multiple, if you're thinking about a fair value peg, as opposed to a lot of promise or a lot of perfection built into the price. So these are healthy rotations. A lot of companies have already had a lot in the pricing already done. So, on Friday they tended, especially the really low multiple stocks, really outperform the market. GM held up as best it could all day long, and then turned negative. But, when I saw the market down 100 points, I thought, let me look at GM. It's going to be a bloodbath. And it was up 3 cents, and I thought, that's constructive. That's pretty good. But, the thing is being beaten up so badly now as it is, that I don't think it would go lower. Now, I'm going to say something that's very odd, and you may think I'm absolutely crazy. For some stocks, it's never been a better time to buy. Stocks like Ford, GM, the home builders, some of the Reits that are down, some of the banks that are down, it's never been a better time to buy. The best time to buy is when everyone is screaming, don't buy it. Don't buy it. Because if everyone is screaming, don't buy it, there's no one left to sell. All the selling has been done. It's the most negative it's going to be. And those are turning points. When everyone is throwing a party, it's time to leave. When everyone is crying in the streets and throwing things out, that's the time to start picking them up. As Warren Buffett said, you buy when there's blood on the streets. And last week there was, if you look at home builders and the automakers, other than Tesla, of course, Ford and GM have never been lower. Now, I am working on my video for the legacy automakers. And fair warning to you Tesla fans out there, it is going to be both respectful to Tesla because they have done incredible to this point, but it is going to point out some realities of Tesla you're not going to like, and it's going to point out some realities of competitive dynamics going forward you're not going to like. So if you're a Tesla fan and you only want to hear good stuff about Tesla, don't listen. Don't listen, because I'm not going to say stuff you already believe in. I'm going to say stuff that makes you think about things, and if your initial reaction is to say, oh, Boomer doesn't get it. No, I get it. I get it. So I'm still working on that. I tell you, when you start down that alleyway, it branches off into a whole bunch of different things. I should look at this, and there's the battery, and there's the supply chain for the battery, there's the amount of capital X that's coming up, there's the constraint on this, and you start to realize that, wait a minute here, None of this stuff can really happen the way everyone says it's going to happen. If everyone says they're going to do, it's like everyone's saying, I'm going to this burger joint this Friday. And this burger joint can hold 20 people, but 400 people say they're going. You know it's going to be a mess, that it simply can't happen. 400 people simply can't show up to this burger joint. Well, with everything that's going on and all the announcements that are being made, you're looking at saying, okay, well, number one, none of this stuff is going to happen. Or I shouldn't say none of it, but nowhere near this stuff is going to happen because it can't. Because it can't happen. Anyways, I'm giving a lot away on this one, but that is coming in the next week. Fair warning. If you're a Tesla fan, I will be nice to Tesla, but I will be truthful about the data and the trends that are happening. So you're going to hear stuff you don't want to hear. And I know that some of you can be overly sensitive and you just want to lash out and call people names. Don't watch. How do we trade on this now? This is interesting. And I think it sets up a really nice trade. So we're going to take a look at volatility skew, and we're going to see how we would position ourselves to trade now that we know some of these fundamental levels here. How can we use them to trade? All right, here is skew, and I've chosen the June contract to set up a trade on. May is just too soon. You have the central bank meeting at the beginning of May, and then you have a period of time in which you don't have anything going on there. Earnings will pretty much be over. That can be digested. So I've chosen June. And down here is our term structure of implied volatility. And the bright yellow line is today. And this less bright yellow line is 2 weeks ago. And the really faded line down here is 1 month ago. We've gone from being in contango to being in backwardation because volatility has spiked and it drags that curve up. And among the front months here, up to about 50 days, which is where June would come within around 50 days, we can see that it is elevated. This dotted line over here is the current skew for June. There is 2 weeks ago down here, and there is 1 month ago. So we do have elevated implied volatility on the puts and across the term structure. And when we have this, we can get risk reversals with asymmetric risk profiles. So let's set up a few of these. Let's say that we're interested in the 18x call. By 18x, I mean the level on the index that corresponds to 18 times forward earnings on an unadjusted basis. That was 42.46 on the index. So I just said, well, let's get a call at 425. For June, it's going to cost 10.57. And you can finance that with a put at 396. That'll cost 10.64. So that's 11.55 SPY points to the upside, but you have almost 17 and a half points to the downside of protection. Those are your break-even points on this. Break-even at expiration. This is a convex trade, so the moment it starts going up, you're going to start earning money. Because your short put is going to lose money, which is what you want, and your long put is going to gain money, which is what you want. You can step into a risk reversal as well. You can just buy the 425 and wait to see what happens. Either way, you win. If the market rebounds, your call starts making money. If the market drops even more, you can go further in the money than 396 to finance what your call was. So if the market drops another 100 points on Monday, well, you can go down to 386, maybe even 384 to finance the 425 the 425 call. So you can either put on a risk reversal right away or step into them. If you want wider, maybe you're thinking, I don't like 396, that's too tight to where we are now. That's only 175 points down on the index. You can go to the 19 level, which is 448 on the index, 224. Not a lot. It's not going to cost you a lot to buy that call. But look how deep you can go on the puts. You can go to 335 and get 234 for selling the 335 to buy the 448. So you're 345 points up for your strike price, financed with 784 points down on the SPY. That's $78 down on the SPY to finance a call that's 34 points up. That's a nice asymmetrical payoff, because the further you go on the puts, look how high you're going on the implied volatility. So you can go deeper and deeper out of the money on the puts to finance a call that's not that far out. If instead of, maybe you don't want to choose based on where the calls happen to be, maybe you're comfortable buying at a certain multiple. So you might say, you know what, I'm comfortable buying the SPY at 16 times forward earnings. Well, that's 37.75. So we can say that's 378. Let's just go ahead and sell a put at 378. We'll get 657. That will finance a call at 433. That'll cost us 655. So 19 and a half points up, 35 and a half points down on protection. So you can find some strikes based on multiples that are higher than where we are. You could say, I'll buy a call at 18 times forward earnings or 19 times forward earnings, or because if you buy the call there, that'll determine where your put has to be. Or you can start with the put and say, I'm comfortable selling a put at 16 times earnings, and that will then determine where you can go and buy the call. But when you have elevated skew and elevated implied volatility, risk reversals make a lot of sense, because you get this kind of asymmetric risk profile where, for something like this, the market only has to go up 115 points to hit your strike, but it would have to fall 174 points to hit your put. And again, because they are non-linear, they start, the moment the price starts going up, the call will start going up because you're long. The put will start going down, but you're short. So your delta will begin to increase as the market moves up. If you think that's going to happen, if you like risk reversals, I like them when I have this kind of skew, and I like finding a level at which I would say, you know what, I'd be long the market here anyways. And I think 378, this one here, to me looks like a nice attractive place to be. We're 50 days out to June. If it gets put at me, I'm long the market at 16 times forward earnings. And that's 16 times, if I assume that, well, wait a minute, that's just the estimate. That's not the estimate plus the estimated beat. If I think about it in terms of the estimate plus the estimated beat, that's really a 15 times multiple on forward earnings on the market. Now, one thing that I'm fairly certain about with the market, and I've heard this given about bonds, I'm not going to buy the market. I'm going to buy a 5-year bond, because with a 5-year bond, I'm going to get my money back. I just have to hold it to maturity and I'll get my money back. And I would answer with, yeah. And listen, I don't know where the market's going to be in the next year, the next year and a half or two, but where's it going to be in 5? Higher. Look at the history of the market. Higher, higher. If you buy on dips, on significant dips, if you go back and you say every time the S&P has pulled back 10% and I bought, where was the market 5 years later? Higher, higher. So the argument about I'm going to buy a bond because in 5 years I'm going to get my money back. Yeah, same with the SPY. I'm willing to take that bet that I'm going to get my money back in 5 years, because every time you go through the price history of the SPY and you find it down 10%, from whatever high it was, any drawdown of 10%, make a note of where it is, draw a line, a timeline 5 years out, and look at where the index is. Higher, higher. So where's it going to be in 5 years? Higher. Where's your bond going to be in 5 years? Par. Par. That's it. Here's something interesting, the earnings yield. If you look at the earnings yield on the S&P, so to get the earnings yield, you would take the forward earnings, just the forward earnings estimate. You can increase it by what you think the expected beat would be, and you divide it by the 4,100 that we have now. Just rounding it out, 235 divided by 4,100, it has an earnings yield of 5.7%. Okay, let's have a look at some Canadian apartment REITs. And I think for our American friends watching, this is a good opportunity as well for two reasons. You have King Dollar right now. So these Canadian apartment REITs are super cheap to you on a US dollar basis. But I do think that the Canadian dollar is going to gain strength into the end of the year. And if the Canadian dollar gains strength into the end of the year, those Canadian dollars buy more American dollars on the way back. So there's, on an unhedged basis, being in a Canadian asset can be quite attractive. This is 6250 or roughly around 6250. We're looking at cap rate right now, Canadian apartment AP, Canadian apartment REIT. I just call it cap rate rather than saying Canadian apartment REIT every single time. Down 20, almost 20% on this closing basis, 50.32. I've already bought some shares of this one, but I want more. I bought an initial position of which I've already sold the call, and I do plan to sell the put. That would create a short straddle on the stock. Great income play that can give you 3 to 4 times the normal dividend. Right now the dividend is 2.89%. Some other ones that have pulled back, Minto, Interrent, Killam, Boardwalk. Boardwalk has exposure to Alberta, which is doing fairly well considering the price of energy, so they've held up a little bit better. But on average, most of them are down, on average, about 20%. No options here, no options here. I don't know about Killam. I don't really use that one. Low dividend yields, under 3% on all of these, very low dividend yields, but they've had good growth rates because they have enough to reinvest, or they leave enough to reinvest. I do have positions in Minto and in Interrent, but small compared to what I normally would take, only because they don't have options. I have a bigger play here. I bought 15,000. I'd like to get to around 35 to 45,000 of these because I can create a great income stream. Down at 50.32, dividend of 12.1 cents per month. Look at these implied volatilities, 99, 98, 97 in terms of percentile, 52 weeks, 26, and 13 weeks. So I can do a rolling 1 month short straddle on these plus or minus 6% on the price, 53.47, considering this is at 50. Plus you get the dividend every single month as well, so it just the proceeds from the short sale, 44 cents from the short sale plus 12.1 on the dividend, is 1.89% per month, and of course rolled over and reinvested 13% a year on just the income portion of this. The nice thing about doing the monthly is that you can then change your strike prices every month as the underlying changes. So as long as the underlying doesn't increase more than 6% or decrease more than 6% in a given month, they won't be called or put. But I want them to be put to me. I have 15,000. I want to get to this amount by having them put to me. I have no problem with having them put to me because I want to get there, but I want them put to me. Because I'll get a lower price, obviously. If they get put to me, I don't have to buy them at 50 and ride them down to 47. That's all air. It wouldn't matter to me if they go down to 47. They'll be put to me at 47, but the put price, the combination of the put and call price lowers my average cost. So I'm more than happy having them put to me to build my position. If they don't get put to me, I just keep making money on them. So you can use the rolling monthly, or you could just say, well, you know what, let me go out to December and I'll do a plus or minus 10% on the straddle. So I'll sell a 55 call, which is up here, and I'll sell a 45 put, which, if this price index continued on, it would be somewhere down here, and leave it at that. You get 255 for that. So if it gets called away, I had my S in the wrong place there. Your effective selling price, ESP, is 57.55. Your effective purchase price is 41.45. Both of those are good places to be. If it gets called away at 57.55, you paid roughly close to $50 here. It's roughly about a $7 return on $50. That's 14% if it gets called away, 14% over the next 8 months. So this is a nice income component in a portfolio. You can't have everything in growth. When you get your portfolio to a certain size, you simply just can't have everything in growth, only because in sell-offs, your drawdowns would be unbearable, would be huge. You're talking, when you say how much you down, you're not saying, you know, thousands or tens or hundreds of thousands. You got to say it in terms of millions, and it hurts. So you do over time have to have a certain part of your portfolio that is there to generate income, and it'll be less variable, so the drawdowns there aren't too bad. And I usually buy these whenever there are pullbacks, is when I typically say, well, this looks interesting, let me load up, because I know I can generate an income. Good enough. I can generate an income, and it's a nice safe place to hide. If everything is crappy out there, I don't mind being in an apartment building. Because again, if you look at a long-term series of the value of apartment buildings and the value of rents, where have they gone? Up. Where is this going to be in 5 years? Higher. Private equity over the last little while has had a nasty habit of taking all the good apartment REITs and buying them off the market and making them private. Nasty habit of doing that. In fact, if you want to get into some good apartment REITs, you really do have to go through private equity to get to them. So there's always that possibility that, hey, listen, lots of money is running into the alternative investment space. Lots of money is running into private equity. They're just buying stuff that if I sit in the best of what's available, I have a good probability of being taken out as well. But this is a pure income play. I don't mind selling the calls. I don't mind selling the puts, and I would do it 150 at a time because I have 15,000. I would do a full covered call and a put because I do want to get to triple the position that I have right now, so I can afford to have them put to me a number of times. I find that interesting on the REITs. For the Canadian people watching, I've already jumped into some of the Canadian banks because I find them interesting at these levels in terms of the income. I don't mind being paid to wait. Even if they take 2-3 years to do what they want to do, I look at the income that I'll be getting, I look at the options that are available, and I say, can I engineer a double dividend? And if I can engineer a double dividend with the options, I don't mind I don't mind waiting for the underlying to recover and appreciate if I'm being paid to wait. It's better than being paid in a bond. If my strategy is to get paid to wait, I'd rather get paid a dividend with and an underlying that has some good options than to sit in the bond. Okay, what's going on with the U.S. dollar? One argument you can make is, well, the central bank is saying we're going to raise rates and we're going to raise rates aggressively. Yeah, but all central banks, I shouldn't say all, but a lot of central banks are doing that. Canada's already raised 50 basis points, and our central banker is pounding the table harder than the U.S. central banker. Yet our Canadian dollar is dropping against the U.S. only because the U.S. is just strong. And to understand that, we have to look at other big currencies because you need a big currency to accept a lot of money flows. Canadian currency isn't big enough to accept a lot of flows. So money that has to go somewhere looks at the Canadian market and says, well, it's too small to begin with. We need a big liquid currency. So it goes into the U.S. dollar. Look at the yen. I mean, the yen is just losing. This is a 2-year chart. This time period right here is this time period right here. I've zoomed in on the U.S. dollar to show this. You had the yen going sideways for a while. You had the euro going sideways. You had the pound going sideways. And then they all just fell off, and look what happened here. Money is leaving a currency. There is no such thing as a neutral currency where, you know, what currency is your money in? Oh, it's in nothing right now until I decide. You get out of one currency, it is going into another one. You can get out of stocks and not go into anything else, but it's sitting in some currency. You say, well, I don't want yen. Well, what do you want? You got to have another currency. This and this, the yen, the euro, and the pound is what's causing this to go up because no other currency is big enough to handle the flows. Japan is the interest rate differential between any other currency, and it doesn't pay anything to be in the yen. You can get much higher returns somewhere else, but it just doesn't pay anything to be in the yen. So the Japanese central bank is saying, we're not going to move rates at all. We're not going to do anything. So differentials are just going to keep widening and widening. Well, if they're not going to do anything and they're communicating that, there's my funding currency for any carry trade. So there's going to be selling in the end. This is the U.S. Yen, and as it goes up, that is the U.S. strengthening and the yen weakening. This is the Euro U.S., so as it's going down, that is the Euro weakening and the U.S. strengthening. And the Euro is dropping, and the pound is dropping. That's got to go somewhere. The Eurozone is probably in a recession now, and this is catching a cold by default. So when is the US dollar going to turn around? When these turn around. When there is another currency in which you can legitimately see funds flowing into. But if you were going to pick, if you had to be in equities, let's say you run a global equities portfolio, where are you going to overweight right now? Europe? Probably not. There are few markets that can handle a lot of large fund flows. There are some smaller markets, Australia, especially for materials, Canada, especially for materials and energy, but the amount of funds inflow that they can handle are limited. The US is the biggest, most liquid market. If you're thinking about returns on bonds, where are you going to be? Well, you want to be in a country that's extremely safe and one in which rates are going up. Well, there's the US. So it's not hard to see that you can make the case for each of these three areas and say, well, look, on a relative basis, I'd rather be in the US. And a lot of money has to be invested. There's a lot of money that does not have the luxury of going to cash. A lot of equity funds, a lot of bond funds say, we simply cannot go to cash. There is no option just to go sit in cash. We got to sit in something somewhere. And as bad as things are around the world, the U.S. is maybe seen as the least bad. But you're going to have king dollar for a while until one of these things turn around. Now, this is rather odd because typically when you have a very strong U.S. dollar, you would have lower U.S. dollar commodity prices, because commodities around the world are predominantly priced in US dollars. That as the strength of the US dollar goes up, the price of the commodities denominated in US dollars would go down to keep a constant price per barrel of oil, per bushel of wheat. There's no reason that they should be going up in price other than supply and demand. They would adjust for whatever the currency is. But that's not what's happening. Let's have a look at oil. By the way, after we're done with oil and we'll look at inventories on the next screen, all we have left is the economic calendar for the week ahead here. This is a classic continuation pattern that we're seeing in oil. We had an uptrend and we have a pennant flag formation forming, where you have a series of lower highs and a series of higher lows coming into a peak. It's called this is called a consolidation zone. This is a continuation pattern because it is expected that the breakout would continue in the same direction that formed the pattern. We are going to go to EIA.gov and have a look at what's going on. But as the dollar has been gaining strength, the price of commodities denominated in US dollars has not been moving, which normally, whenever you have a weaker US dollar, you tend to have higher commodity prices that are denominated in US, and it works the other way, that when the dollar strengthens, commodities denominated in US dollars tend to pull back, but we're not getting that. It's overcoming all of that. We're coming into the busy driving season. In previous updates, I've shown you what driving looks like when we get into the summer. There is a definite increase in the amount of miles driven in the US in the summer, so demand for gasoline goes up, demand for oil goes up, but we are in a very tight market. Let's have a look at the last report from the Energy Industry Association. All right, here is the release from April 27th, 2022. Next release, May 4th, and it's inventories. They release inventory data every week. Week to week, there's always fluctuations. It's not the interesting chart to look at. The interesting chart is down here. The blue line is our weekly level of inventories. That shaded gray area is what's called a 5-year range. So over the past 5 years, at this point in time, let's say, over the past 5 years, inventories have ranged within this gray range in here, and we have this all the way back to June 20. Notice we had a case of oversupply here, and then stocks just dwindled down. We're below the lower of the 5-year range. That is a very, very tight market, and we're going into the busy driving season combined with a continuation pattern that is very clear on oil. So this fundamental information that I'm showing you here, combined with the technical view we have of the chart, suggests to me a very high probability of a breakout in oil prices into the summer above 110, and you break out over 110. Where's the top, right? The last top was 130 that we hit on the invasion of Russia into Ukraine. You might breach that 130 and head to 150. But both the fundamentals and the technicals are and especially the time of year, the seasonality going into the busy driving season, are pointing to a breakout in the price of oil. This starts to get interesting as well here. Look at this chart here. This is well drilling completions versus the price. So here's our price way up here. Here is, from 2021 over to 2022 where we are now. Notice that it's not really moving up. It's just trending sideways. So you have a tight market, but supply does not seem to want to even budge. If this were moving up, that wouldn't be too bad. It's held pretty close for quite some time, all the way through, but here we're getting this divergence. And listen, I don't blame them. I don't blame the oil companies. You have governments all around the world saying by 2030, no more internal combustion, 2035, 2040. And you have car companies saying by 2025, 10% of our fleet will be electric. By 2030, 50% will. By 2035, we'll be out. Well, if you're the CEO of an oil company and you're hearing all this, you're going, why the hell would I invest any money in any new fields right now when you plan to make my product obsolete? Why would I even do it? So CapEx is going to be hard to come by, which means I think you're going to have this tight market for quite some time. What do we have here? This is CapEx for 14 oil field services companies and employment in oil and gas extraction. So the green bar is employment, and the other one is CapEx. This is for oil services. These are the ones that service the oil companies. I don't know enough about the dynamics in the industry to read too much into this. And you have this one's fairly interesting as well. This is drilled and completed wells in oil-producing regions. It says here DPR, Anadarko, Bakken. These are the shale fields. Now you see these negative bars. That means it's negative year over year. But you're comparing this number here with this number back here. This is called base effects. Even though it's rising, it's showing year over year is negative. It's because you're comparing this number with this higher number year over year. But it is going in the right direction. Anyways, this report is in the description box below for those of you who like oil, who like the oil market, who probably know a lot more about it than I do. There it is for you. All right, going into next week, what are we going to pay attention to? Monday, this could set the tone for the day because we don't have a lot of earnings before the bell on Monday that could move the market. You got the Fed on Wednesday, which everyone will be focused on. But we have ISM manufacturing PMI, which if it comes in better, I don't know that it's going to help much, but if it comes in worse, it just could be yet another reason to start selling again. Construction spending month over month. You have factory orders coming in on May 3rd. And mortgage applications aren't going to do too much. It's just something I like to watch. ADP employment change, you know what? It used to have a good relationship with the jobs report, but in the last, I'd say, almost 10, 15 years, it doesn't seem to have much of a relationship anymore. I don't know that it even moves the market anymore. This will be watched for March. We already have the Q1 GDP. We already know that the trade balance is what dragged it down. This will just be for the month of March itself, backwards looking, but I think there'll be some conversation about it. ISM non-manufacturing, but the big thing is here. This is at 2 o'clock on Wednesday is the Fed rate decision. Previous is 0.5. The forecast is 1%, meaning a 50 basis point raise. And then the press conference. The press conference has a way of moving the market a lot more than the initial release. When the release comes out, there's a bunch of buying and selling, and the market goes up and then down and then back up again and back down. And it says, hang on, let's wait to hear what the guy has to say. And then it starts taking direction based on what he has to say. So it's what he says. They move 50 and he comes out banging the drums and talking hawkish. Yeah, you're probably going down into the close. But then again, if everyone expects it to go down, maybe you'll rally into the close on really hawkish statements because everyone says, we expected it. It's not as hawkish as we thought. I love the market, and sometimes I freaking hate the market because just when you think you got it figured out, it does something where you go, why? Why are you doing that now? I wouldn't have bet on that, but there it is, And then this is the big thing on Friday. After we digest this, we're going to look at jobs. We want to see job creation. We also want to see increases in our average hourly earnings. I want to see it at least. I think it's a good thing. I really do think it's a good thing. If you want a healthy market going forward, it's a good thing to have a healthy consumer in a healthy economy. But, the market may have a different position on that. And why wait? Why not start job owning right away? There's Williams, and then at 320 you have Bostic, and then these guys can't do any harm. The market's already closed. Waller and Daly, but the open mouth operations start very, very soon after the open market operations are announced. That is the week that was. That is the situation that is in terms of where the Fed is, where rates are, where the economy is, where earnings are. And this is the week that is going to be. All eyes on the Fed.